Well, hello everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Schwab. And today we have a lot to cover. So it's going to be a lot of wash, rinse, repeat going on today. And what do I mean by that? Well, when I left for New York last Thursday after last week's class, we had a lot of trades in play. And we still have a lot of trades in play, but we have a lot of trades that have hit targets. So we're going to look at the trades that have hit targets. I'm going to do a very quick review of those. We're going to look at some of the trades we have in play and do a little bit of trade management. And then we're going to place a bunch of new trades. And I'm calling this wash, rinse, repeat. And I have been treating this class as a companion class to the trading a smaller account class that is Mondays and Fridays. And next Tuesday, the Barb 2.0 project kicks in, and I am going in for a new left knee. So my current left knee has taken me on a lot of fabulous adventures over the decades, and I'm just bringing in some kind of reinforcement so that we can continue having adventures, but it means I'm going to be gone for 6 weeks. Kevin Horner will be filling in for me for this class, and for Mondays and Fridays, the Trading a Smaller Account, it will be Connie Hill filling in. And so the trades that we are going to place in today's class, it will be Connie Hill that does the follow-up on those. And Kevin Horner will be introducing you to, a bunch of fabulous new projects and all that kind of good stuff. Okay, so that's kind of, my big news. Alrighty. So let's get right down to it. If you're not following Kevin and I in the Land of X, you are missing out, my friends. Kevin Horner CS, Barb Armstrong CS. The market drive in New York was fantastic. If you want to see a few pics, if you can go to my Twitter, Joe Mazzola's. You can go to Ben Watson's. He was there. And just kind of see what you're missing out. The next one up is in Santa Clara. We are like packed to the gills. If you don't, if you haven't got a spot, if you show up, you'll have to wait and see if there are seats available once all the people who have tickets can attend. So, we have a limited capacity in Santa Ana, but it's a very popular event. So if you're thinking about going to an event later this year, as soon as registration opens up, sign up immediately, and then you'll avoid that potential headache. Okay, so back to our regular programming. Know that options carry a high level of risk and aren't suitable for all investors. The information that we're going to talk about here is for general information purposes only, and shouldn't be considered to be a recommendation on the part of Schwab or myself. This is an active trading class, as is the Trading a Smaller Account. We talk about concepts, and then we place lots of example trades, and then we follow up on those trades because it's kind of learning by doing, or taking concepts that you can learn in a course and applying it in live webcasts like this, which I think is what makes these webcasts such an incredibly valuable resource. And I hear that time and again when I go out to these live events. Now, Kevin Horner will be in Santa Clara. He'll be in Chicago while I'm doing the Barb 2.0 project. I'll be gone for the rest of July, and I won't be back until at least the 18th of August. So, have a fun summer. We use the Thinkorswim paper money platform on the Thinkorswim desktop. It looks like, smells like, feels like real money. One of the differences, though, is that short options will never be assigned in paper money. That can happen in a live account. Okay, okie dokie. Okay, so let's get out and have a quick look. Now, Kevin does a great class on Wednesdays. He partners up with Brent Moores at the Market Open called Trader Talks. But just know, and he covers what's going on in the markets in depth, but just know the S&P 500 hitting an all-time high today. The NASDAQ hit one on Monday, because this is Wednesday. And, it's snuggled right up next to it. At the moment, the Dow has had, a more modest comeback, but it too is still up 4.4% on the year. The Russell it's the only one not in the green. It's year to date down 0.5%, where when we look at, the NASDAQ, it's up 6.7% on the year. And the S&P is up 5. So we're seeing a lot of bullishness now. There's tariff talks kind of rearing their ugly heads again, and we'll have to see where that takes us. But what that's providing is a little bit of, of interest when we look at some stocks and their volatility. But volatility back at 16.7, I mean, we haven't seen it down, this low for some time. What it's hit in the last week is below that kind of 17 that was acting as a support level for the last few months. Yeah, I think the Houston event is close to the end of the year, is it not? Yeah, I'm hoping to go to Houston this year. I haven't been since COVID, so that would be great. Okay, so yeah, if you've never been to a live event, I'd highly recommend it. I mean, I loved attending them as a client. I love attending them still. And I'm continuing to learn even as a coach when I go. So my expectation is that you would walk away with nuggets that you can incorporate into the way you approach the markets as well. Okay, so let's start. Why don't we start with, let's start with Goldman Sachs. So, I did a trade management mini session a few months ago. We'd done 6 or 7 trades on Goldman Sachs. They were all bullish, and those all just happened to work out. I think most of them were long call verticals, and it was a variety. But we kept doing this wash, rinse, repeat thing. And so here we have something where we bought the stock back on this day, I believe it was. Oh, let's come to Monitor tab, and we're going to come to Goldman Sachs. So we bought 7 shares of stock for $636. And sometimes, like when we have a small account, and our account is currently sitting at, 28,000. So it's shares, $5,000 worth. Okay. And it's up 12.3%. And we put a target on it. So if we look at when we bought this, it was June 18th. So it was this date, and it's just moved up nicely. Now, I think this target was based on a Fibonacci extension. And our target is 729. Now, we have a bunch of things we want to do today. We only have $3,000 in cash. So I'm going to put a little survey or a poll in the chat. Do we want to take the money on this one, or do we want to just let it continue to move? Because, in this class, like we consider $100, gain a base hit. So, and we're up $551 on this. And what the market giveth, the market can taketh away. And so not trying to make a fear-based decision. So if we decide not to take the money on this one and free up this 5,000, what we're going to do is just tighten up our stop or adjust our stop, because our stop is currently, for Goldman Sachs, it's at 598.35. I'm going to write that down. 598.35. So we would adjust our stop to 3% below a recent low. Okay, so here we go. Here's our poll. So are we going to cue Steve Miller and take the money on that one? Or do we want to just be patient? Now, in all honesty, if there wasn't a ton we wanted to do today, we might just choose to be patient. Because when we look at the chart, it's not like we're looking at it and saying, hey, I think that this is about to turn around. And if we move up our stop, we would look at this low from yesterday at 761. So 761, and maybe move it up, 2% below that. So we'd move it up to, if we decide not to get out, we'd move our stop up to 686.60 from 598. And so we're moving our stop up dramatically. Here's our stop at 598.35, which made sense from when we placed the trade here. But now if we want to protect some of our profit, we might move it up to here and just let it go. So somebody's saying B of A raised their price target. Yeah, so this morning, Bank of America Securities raised the price target to 775. And somebody's saying, oh, well, move up the stop. And, when we look at things like this, there is a common challenge with traders like you and me. And that challenge is that we tend to take our profits too early, and then we tend to hold on to the losers too long. Okay. And so even though we have a 70% vote here, our target is, we're at 716. So we have $13 a share more. So $13 times 7, we're within $100 of our target, right? We're within $100 of our target. We're within, $91 of our ultimate target because we have 7 shares. Okay, so I'm going to let that one just ferment for a second, but could we layer another trade on this if we're kind of not doing okay, guys, so with Goldman Sachs, we're going to layer on another trade here. And we're going to look at a short put vertical. And I don't know quite where we lost me in my stream of consciousness conversation, but we're talking about kind of layering in trades or wash, rinse, repeat. And so we're going to come to this 700, which is, kind of a recent support level-ish or below a recent support level. And if we could get 85 cents on a $2.50 wide spread, so I take 250 minus 85 cents, that's $1.65. Like, that smells like a potential 50% return. 85 divided by 165 for a vertical we'd be in for 2 weeks. That's a potential 51% return. And where would we be putting our Could the trade go against us? Absolutely. And okay. So if we look at this, what's the advantage of a short time frame is if it goes right, we'll have is earnings the 16th? Dang it. Okay, let's look. Earnings is the 16th. Okay, what's one of our rules with a short vertical? We don't trade it over earnings. Now, that's our example trading plan in this class. No wonder that the premiums were so rich. So, Susan, thank you very much for catching that. So with Goldman Sachs, we could stay in the trade, and I'm so proud of you guys that you're feeling hesitant about just taking the money and running with it. But, if it did have something negative come on earnings, and given I'm going to be away, we are going to take our money on this one. The majority has spoken. Okay. So we're going to come to the monitor tab, and we're going to come to Goldman Sachs. And although I would have loved to put that other trade on, that's breaking a rule. And that's one rule we don't break. Now, there are some people that will do short vertical trades over earnings because the premiums are so rich. But those tend to have a binary result. Either it works out very, very well, or it works out very, very badly. So Goldman Sachs, we're just going to cancel this whole group. There it goes. At least this is how I tend to exit these. So we had our position and we're going to take our unrealized gain in this example trade and turn it into a realized gain. Okay, so we're going to create a closing order to just sell it at 7.15. Cha-ching. Okay, so we put the money in the kitty. Now, Affirm is another one. So, we're up $633 on Affirm. And you can see that we also did a long call on Affirm. We're up 190 on that. And you may say, like, wow, the stock was a way better investment. Well, we have a 10% return on the stock. But, we have $6,800 in this stock now. That's a lot. It actually is breaking our $5,000 rule. And we may have done a buy right on that to begin with if we went back and looked at it. But, so we could just sell part of the position. We also have a long call. And on that one, how much did we invest? $510. So that, we're still, good to go on that. We're up 36% on that. Okay. So, and then we had a short put also on Affirm. But let's come and look at the chart. And we were going to compare these. And so, this came back on Tuesday, like so many other things did, and then moved up. And we had this $79 target. Again, this was based on a Fibonacci extension. And so, what do I mean by Fibonacci extension? If you're new to this, is if we came down here and we said, okay, it broke out and came up. So if we measured the distance from here to here, you know what? Maybe it wasn't a fib extension, because that would be at 72.56. So that may be something that we want to watch for. I think maybe this was trading it to a previous high then. I usually will put that in the notes. But, we've come up here, and if we look at the stock and we say, well, here was our recent low here at 66.54, we're going to adjust our stop to 3% below that, which would be, say, 64.54. So that would be our new stop, 64.54. And this is going to be our stock position stop. And so what we're attempting to do here, and there's never a guarantee, but what we're attempting to do is just to provide some protection of some of the profit to the downside, because we bought the stock for 61.74. And so we'd be giving up, potentially half this profit, but we're looking to protect half of it. And of course, with the stop loss, there isn't any guarantee. But, this seems to be moving along. So maybe we just let that continue to do its thing. Okay. Now, how would we adjust that stop? So we're going to come to our working orders for Affirm, and we are going to say, well, our stop was at 55.16. We're going to move that up by, $9 and change. So we're going to cancel and replace this order and make our new stop $64.54. 64.54. Now, when we look at the option with this, we want to do the same thing. So here's our option. And you'll see that we had that same 55.16 exit and the same target as well. And our intention was to compare them. So what we're going to do with the option is we're going to cancel and replace that too. We're going to come to our little sprocket, bring up the conditional order, and change that to 64.54. 64.54. Okay, and I'm going to hit enter so that I can see it down here. Save. And so again, what we're just looking to do is one, we'll compare this to the long stock position at the end. That is Affirm and Goldman Sachs. Now, we had a bunch of short put verticals. Actually, Affirm was not one of them. But could we add a short put vertical? You know, and our recent low here was 66.54. Could we do that around 65? And let's look at when earnings is August 27th. So, or could we come out to 65 and maybe come out this 23 days? We've got 19 contracts, 7-cent bid-ask spread. So that meets our requirements, just barely. We want it to be at least 20. But if we did 65 and say 63, we'd get 65 cents on a $2 spread. So that's 65, and we're risking $2 minus 65 divided by $1.35. That sounds like about a 50% return potential, 48. So if we're saying, okay, we're good on that, we're risking what? $1.35. So if we did 3 of these, we're risking about 450. Oh, 405. You know, we could probably do 4 of those. So if we did 4, we're risking 540. So just over 5. So if we're okay with that, we're going to say, okay, single order, first trigger sequence, right click. And we're going to buy these back when they're worth about 13 cents, 80%. Now, if Connie looks at these on Monday and says, hey, we wanted to buy these back when we had 80% of our max gain, but we already have 50. You know, and the beauty of the 4th of July is that time keeps ticking away, even though the market isn't open. So we get this time decay bonus when the market is not even open. We get 3 days worth of that over the weekend. And so we're going to put that in our short put vertical bucket. Now, we had several short put vertical positions on. And in the week I was gone, a lot of those hit their targets. So that was Affirm. We just did a short put vertical. And how did I figure that out? I just came. And so if you've been on vacation, you can come to your account statement and say, you know what, let's just look back at the last 7 days since I last looked at the market. And we can see that a lot of positions closed. So we had a long call vertical on Yum that hit our target. We had short put verticals on NVIDIA, on Meta, on Amazon. Those all hit their targets as well. Okay, so if you're wondering what happened to those hit their targets. We also had a short put on Affirm. And we've done a couple of those, and a short put on SMCI. Okay, so, and we've had several trades on SMCI. So let's go and look at a different trade first, and then we'll come and we'll look at SMCI. So Google, and I know I'm a little bit like all over the map here, but you know, Google's been kind of, a wee bit like compared to several other stocks, you know, which have been just kind of riding this recent high, but we've had a bit of an inverted head and shoulders. Oh, no wonder that wasn't clicking in for me. Wrong drawing tool. I wanted a straight line. You know, so we had this, it's not perfect, but a bit of an inverted head and shoulders, and then it broke out, came back and retested this line and is breaking out again. So we have earnings coming up when? The 22nd. We have this old resistance around 174. This 174 line seems to be holding as a support. It's now at 178. Could we come out even just 2 weeks, because earnings is the 22nd? Could we sell that 172.50 and get enough premium for it to be worth our while? Well, 50 cents on a 250 strike, that's a 25% return. You know, if I take 48, you get good at certain kinds of math. You know, that's a 23.7 or 23.8% potential return. For a trade we'd be in at most for 16 days. When we come back to the chart, earnings is coming up. So we have to be directionally spot on here. You know, like in that it has to stay above 172.50. You have, you know, about $6 worth of wiggle room. But it's you know, a bullish to neutral trade, and we know that it's a short time frame. So the advantage is if it goes according to plan, we're in it for a very short time. If it doesn't go according to plan, we don't have as much. So we're going to come to first trigger sequence and buy this back when it's worth about 10 cents. So again, that kind of idea of when we've got 80% of our max gain, we're going to take it. And we don't want this to be 4, we want it to be 2. Because we don't want to risk more than $500. So we're risking 400, cool with that. We're going to put that in our short put vertical bucket. So this is kind of more modestly bullish, and this is Google. So that's 2 short put verticals, check and check. And Goldman Sachs was a no-go because of earnings. Okay. Now let's come and look at SMCI. I know this is one that Kevin has frequently talked about. And man, it's, well, a lot of things had a lot of trouble this year from February through April, right? And then it kind of made a bit of a comeback and then hung out and, you know, went a whole lot of nowhere. Did the sideways shuffle for a bit, but it seems to have broken out above this previous high around 47. And we've done a lot of trades on SMCI. The most recent, if we look at SMCI, oh, let's go back just 40 days. But we did a short put. And we've done 2 puts. So we sold the 39 put for almost $2, bought it back for 30. So our example gain on that was 169. Then we sold another put for 148. And I guess the idea here was when we had 80% of our max gain, we'd buy it back. So that order triggered on Monday. So, you know, we made what? 148 minus 29. So we made, I don't know, 110 bucks on that. So if I take 31.18, we made, you know, $119 on that. So could we do another one? And we also have on here, we did a buy right covered call where we both bought the stock and sold the covered call with the intention of it being called out, but we said we would be okay if we ended up continuing to own the stock. So on this short put, this is the short put that was out, but if this is bouncing and we're saying we'd still be okay with owning stock, could we sell another short put at 47, wanting to be out before earnings on August 12th? And then let's go and look at this buy right covered call. So with our buy right, and this is on SMCI. So let's come up here. So the most we can make on this is if we get called out at 47, right? Right. And we bought the shares for $43.75. We were paid $2.34 for the call. So we were in it all together for $41.41. We're currently up like $350. Okay, so we're up $350 on this one. But at 45, we're still $2 away from our max gain, which comes July 18th. So July 18th, that's, a week from this Friday. But if we could make another $200 and it's in the money, it's trading at 48.30. So if it stays above there and it looks like it might, we would continue, we would be called out. But could we look at this and say, hey, could we roll this maybe to 50 and go out another month? And that would be another $300. So what are our choices? We could buy it back now and we've made a nice return. We could wait until the 18th and see if we get called out. But this is looking pretty bullish. It's come back, retested, and we have a bullish candle on the chart today. Or could we look at this and say, hey, could we look at a rolling strategy, where if this is worth 340 to 350 today, maybe come out to August and do the 50 or, even something higher. And if we get a credit plus, we could make $3 more. Might that be of interest to us? Well, it's interesting enough to look at for sure. So with SMCI, we have an exit in place. So the first thing we have to do is cancel that exit. So we're going to take our stop loss and just cancel that. Because if I want to do a roll on that buy right, then I have to not have a stop currently in place. So if I say, okay, this is worth 345, if I create a rolling order, it will go out to the next closest date at the same strike. So July 25th. We're going to say, what if we went out to the monthly August 15th? We'd get a credit of 262. What if we went out to the 50 strike? We'd still get $1.30. So that means we could theoretically, our upside could be another $3 a share on the strike price if it went up to 50 and another $1.30 credit. So if we say, well, yeah, that looks pretty good to us, we're gonna do that roll. We'd come to confirm. And this was a roll of the 47 strike, expiring July 18th. Okay, so we'll make sure that fills, and then when it fills, we'll go in and put a new exit in place. And so it's filled. Where might we put an exit in? And it's so much easier, my friends, to avoid the pitfalls of being a human being. And it's a wonderful thing to be a human being. But one of the pitfalls is that, like I said, we tend to take our profits too early, and then we tend to hold on to the losers too long. So if this goes against us, if we make a decision now on how we define, wanting to exit, maybe we look at yesterday's low. That was 46.37. How about this low over here? 46.07. How if we said if it went 2% below that, 4607 times 0.97. So if it hit 4468, we'd want to exit. Our previous exit was probably below this 39 level. But we're going to say, okay, if it goes below 4468, let's take the money and run. So how would we put that trade in? Well, I'm going to come here, highlight, we want to highlight this whole thing. Right click, create a closing order to sell our covered position when? At the market price, if and only if SMCI goes below 4468. So now we're not making an emotional decision. And you may say, oh, I wouldn't be emotional. Yeah, I've said the same thing. That and other lies we can sometimes tell ourselves. You know, not that we're the same, but, you know, humanity is humanity, right? So we're saying, hey, if this goes below 44.68, so we're giving it, you know, $3 and change worth of wiggle room. And what we're saying is we see this 46 level as being a support level. And if it breaks that support, we're going to lick our wounds and live to trade another day. Now, we may still end up, you know, out bullishly on the trade. Okay. So that's that one. Now, the premiums are fairly rich on this stock. It's a more volatile stock, like we can see here, you know, and so even for July, the implied volatility is 75%. What does that mean, my friends? It means that you know, the premiums are pretty juicy. So if we look at this July 18th expiration, could we sell a put at 47? Does that break our position sizing rules? Well, no, because if it was put to us, that would be a $4,700 position. Now, if you're in a cash account, it will say, hey, we're going to take $4,700 and take that out of circulation until you close this out. So if I take a look at a dollar, let's call it $1.95 divided by 47, that's a 4.1% return for a trade we'd only be in for 16 days. But we could end up owning the stock. You know, that's a possibility. And so what we're going to do is we're going to right click. We are going to sell a put. And then we're going to say, hey, you know, busy time, doing a lot of socializing over the 4th and all that. And again, what's delicious, you know, or appealing about selling a put here? One, we've already talked about the fact that implied volatility is high. But two, this is a 16-day trade. And in the next 16 days, the market's closed for 5 of them. And yet time decay is ticking away. So if we are correct in our analysis that this is going to continue to move bullishly, then, you know, we're okay. And we are going to say, hey, if we've got 80% of our max value, so if this is worth about 40 cents, let's buy it back. And so, you know, base hit, how much can we make? The most we can make on this if we get out, you know, when it's worth 40 cents is $1.55 a share or $155. But it's like little wins, little wins. Okay. So we didn't look at everything, but I've got to wrap things up. So let me just say this. On Yum, we did a long call vertical. We got in on this day and out the next day. It might have been a bit of a paper money fill, but we got our 25% return. On NVIDIA, we did a short put vertical and we ended up out at 80% of our max gain on that. On Meta, the same. On Amazon, we had a short put vertical. On Google, the Google, as I like to call it, we had a long call vertical, and that one went according to plan. We got out with our 25% on that. What have we done today? Well, let's look at our filled orders. So we did a rolling order, on SMCI. And, if you're new to this class, you could always, do a brand new buy right if you wanted to follow along in your paper money account. But we rolled this out. We did the 50 call in August. We did a short put vertical on Google expiring in 2 weeks, which is a pretty tight time frame for us. And we discussed the pros and cons of that. We did a short put vertical on a firm, and then we closed our positions and we took the money on Goldman Sachs. And then we sold a put on SMCI. So we did quite a bit. 1, 2, 3, 4 new trades. Now, if you're thinking, well, that's short shrift, I would have liked to see more. Well, you could look, if you wanted to do some additional examples at Meta, you could look at Micron. The market is hitting all-time highs. So one might assume there are lots of bullish opportunities where you could go out and try some of these different strategies. Okay, so I will be back if all goes according to plan and the Barb 2.0 project is the big success that I'm expecting it will be. I will be back on the 18th. You're in fantastic hands with Mr. Kevin Horner on Wednesdays, with Ben Watson for getting started with technical analysis on Tuesdays, and Connie Hill on Mondays and Fridays for trading a smaller account. I will miss you as I am rocking my walker around my neighborhood, getting back on my feet and alternating between narcotics and ice packs for the next few weeks. But I love being here. I'm super passionate about trading, as I think you guys can tell. I certainly will continue to have my eye on the markets, although my surgeon has said for the few weeks that I'll be on a certain type of painkiller. Messing with financial stuff is probably not a really wise decision. And so I won't be in here slurring my words and offering words of advice. So guys, have a really wonderful summer. Take care of yourselves and each other. Thanks to Kevin Horner for being in the chat today. To all of you for continuing to show up for yourselves, for your future self, for your families, and for each other. And thanks to the guys behind the scenes. I will see you when I get back. Enjoy the 4th of July. Happy birthday in advance to this wonderful country. Take care, everyone. Bye for now.